Okay. That's all right. Okay. Thank you very much. There we go. Well, thank you very much. Good afternoon, and thank you everyone for coming. My name is Simon. I'm going to be chairing this first plenary session. Let me start by welcoming you to this 2014 annual conference of the CSAE. As you can see on the slide behind me, we have two exciting events planned for this afternoon. At 6 p.m. we have an AERC forum on the intersection between policy and research for Africa. We're going to begin though now with the first plenary session of the conference on mobile technologies and development. I think the concept of mobile technologies is a really important and very interesting one for all of us as development economists. I suspect that most of us, when we first studied concepts of technology and development, were taught that technology is a residual term. And sometimes that meant it was also a residual concept. When we talk about mobile technology, nothing could be further from the truth. And I guess as we all realize, in the last few years we've seen a stunning transformation as one small device, mass-produced, has changed so many areas of what we've always considered to be important as development economists. From banking through to microinsurance, from agricultural price dispersion all the way through to information in urban job search, all the way through to election transparency monitoring and so on. And that's exactly the kind of issues that we're going to be discussing this afternoon. It would be remiss of me if I started a session on mobile technology without telling you about Twitter. We are encouraging you to tweet, whether you're watching here or watching at home, and the hashtag that we've got this afternoon, which you'll see online down in that corner of the screen if you're watching at home, is hashtag CSAE 2014. I think last time that people who submitted questions by Twitter had a statistically much larger chance of having their question taken than people who put their hand up in the hall. But that's not to discourage you from participating in the old-fashioned way. We're very fortunate to have three very distinguished economists joining us on the panel this afternoon. Let me start by introducing them before they speak in turn. On the left, we have Billy Jack. Billy is no stranger to Oxford. He came here as a Rhodes Scholar from Australia to do the MPhil and the DPhil in economics. He's currently working as an associate professor in the Department of Economics at Georgetown University. Among a very wide range of interests, he's worked on mobile money in terms of risk sharing, trade credit, implications for monetary policy, and indeed has written on mobile technology and health, and also mobile technology and price information. Welcome, Billy. Second, we'll have Ignacio Mas. Ignacio is a senior research fellow at the Said Business School here in Oxford, previously a senior advisor to the Financial Services for the Poor program at the Bill and Melinda Gates Foundation, and previously director of global business strategy at the Vodafone Group. And his work currently emphasizes the role of branchless banking. Last but not least, we're joined by Isaac Mbiti, who's an assistant professor at the Department of Economics at the Southern Methodist University, whose research is focused upon issues of education in developing economies, and of course the role of mobile technology with a focus on mobile money. We're going to have presentations of about 15 minutes each from each of these speakers, and then we're going to throw the floor open for what will hopefully be a very interesting group discussion. So thank you very much to the three of you for coming, and Billy, we look forward to hearing your presentation.
I hope this one's on. Does that work? So Simon, this one is supposed to transmit to the online.
So the theory goes, yeah.
So it's not clear from these observations whether it's on. Let's hope it is. So, hi, thanks for coming. And to the organisers, thanks for inviting me. It's so great to be home. I don't know about the rest of you, but graduate school is the time when, it's the formative time of your life, right? And for me, Oxford will always be one of my homes, and it's fantastic to be back. Simon didn't quite get it right. I did come here, and I did do an MPhil and DPhil, but I didn't come here to do an MPhil or DPhil, in economics that is. I came here to study artificial intelligence, and I lasted about a couple of weeks, and I soon realized that, with a prescient view to the future, that really this computer stuff didn't really have much in it, and there wasn't going to be much of a future in that endeavour. So I switched to the econ department. Well, actually, there wasn't even an econ department back then. I switched to economics. And so you might want to take anything I say that's predictive in this talk with a grain of salt. You might want to help me get my slides up too. How do I do that?
Alt-tab.
What's that? What do I... Sorry, all I can see is what you can see.
They should be open.
See what I mean? High tech. That one. Okay. I'm sorry.
Yeah.
Great. So I wish I could claim that I saw the mobile revolution coming and therefore moved to Kenya to be part of it. But in fact, I just happened to be living there when it happened. And so I rode that wave with a whole lot of other people who are interested in this area. I'm going to talk today about just two papers. Instead of giving a broad, big picture view of mobile, which I think Ignacio is in a better position to do, I'm just going to tell you about two research papers that I've been involved in. One is now in print, and so is therefore officially old, and the other is very much just out of the oven. And so I want to just review those two with you, just to give you an idea of where I think mobile technology is helping us. The first one is with Tavneet Suri, who's at MIT, and the second is with my colleagues James Habyarimana at Georgetown and Karen Griffin at NYU. So M-Pesa, I nearly didn't put the word, it's now a word, M-Pesa on this slide because I figured that everyone knows what it is. But just in case you haven't heard, M-Pesa is the mobile money platform that's been developed in Kenya over the last 6 or 7 years. This picture is quite old now, actually. It only goes up to 2011, but it illustrates the explosive growth of customers of M-Pesa. Now, I think the number of M-Pesa customers now is 17 or 18 million. This is in a country with about 22 million adults. So it's one of the most widely adopted and deeply adopted technologies, I would say, in history. Along with the number of customers, the growth in customers, which is the blue line on that figure, the red line shows the growth in agents. M-Pesa agents are people who have money or who are willing to take money from you, otherwise known as human ATMs. And I think the little story behind the technology part of this technology revolution is that it couldn't have happened with a lot of people. The people were these agents who effectively allowed consumers to convert electronic money back into cash with which they were familiar. In the long run, we may well get rid of paper. But in the short run, the transition to electronic money never would have happened if people couldn't easily and conveniently convert it into cash. So the number of agents on this picture was way up at 30,000 a few years ago. Now it's something like 80,000. I think people they're kind of making up the numbers now. It's so big, it's hard to tell how many there are. They're all over Kenya. This is a country with roughly 1,500 bank branches. So orders of magnitude more access to M-Pesa than to regular banking services. So that's where Kenya is, if you wanted to know. I'm just going to show you the evolution of the distribution of agents in the country over the first 3 or 4 years of M-Pesa's existence. This is back in June 2007, 3 months after M-Pesa was launched, and over the next few years, this distribution of agents became much more dense. So I want to, the one thing I want to point out with regard to that evolution was they didn't start in Nairobi and spread out, they had to start everywhere and then get denser everywhere. The reason was that the value added of this service was entirely about sending money over a long distance. And you can't send money over a long distance with only one end of the chain in place. So what did that mean? It meant that there had to be quite a big investment up front by the cell phone company for this thing to take off. So it didn't make money for quite some time because of that investment cost. Here's another picture with dots. These are the households we spoke to over a 2 or 3 year period in the late 2000s. We did a survey of 3,000 households, a comprehensive survey of their consumption, their risks, their shocks, all of this kind of jazz, and their use of M-Pesa. And it turned out that based on that survey, we were able to come to some rather I think, significant findings about M-Pesa. So all of you have been indoctrinated, I know, in the importance of identification. So we didn't randomize anything here. This is all observational. We just talked to a random, well, we did randomize who we talked to, but we didn't randomize who got M-Pesa. But so we had to do a fair amount of econometric work to isolate the impact of being exposed to M-Pesa. But it turns out the bottom line is that M-Pesa uses smooth consumption across income shocks. So if something bad happens to someone who doesn't have M-Pesa or is not, doesn't have access to this service, something bad happening means, well, something bad happens. That is, consumption goes down. Something bad happens to someone who has access to the service means consumption doesn't go down. They're able to insure themselves. Turns out that if a health shock arrives, consumption and health shocks are actually co-vary. So the consumption of people with health shock goes up. Why? Because we include in consumption of medical services. Whereas those people who are faced with health shocks and don't have access to M-Pesa have to divert money from other causes into health spending, if at all, and their consumption doesn't go up. Households with better access to agents, not just those with the service, but who are closer to these agents, are better able to smooth consumption as well. And there we utilise this rollout of the agent network that I just illustrated to identify that impact. How do they do it? Well, it's kind of obvious. Well, maybe not obvious, but the way they actually do it is the way we thought they did it. That is, they send money and receive money more frequently. Remittances are larger in value, they're more numerous, they're more frequent, and they travel greater distances in our data. That is, people who have this technology have a larger and more active network of financial transactions. That's a really nice observation, something that we kind of might have thought was obvious, or at least predictable. This communication technology that allows money to be sent over long distances did exactly that. The money traveled further, more frequently, and in larger amounts. So there's a lot of other literature in the development field now that says, risk is an important thing. Of course, Stefan is maybe not here, but will be here tomorrow. And the importance of protecting households against risk is not just because they have a risk aversion parameter that's not one, but because they make different decisions ex ante about what to invest in faced with such risk. So if this innovation really does allow people to self-insure, or sorry, not self-insure, but informally insure in networks, then it could have significant knock-on effects on the actual level of GDP, if you like, not just the distribution across states of nature. I want to talk now quickly about a second paper that, as I said, it's actually not even out of the oven. I just opened the door to test it, and it needs a little more baking, but it'll be ready soon. And that's a paper in which we look at the specific impact of or use of mobile money in improving health. So we showed in our previous work that I just discussed that remittances were an important way of protecting people against health shocks. Another way that M-Pesa might allow people to improve their health is through precautionary savings, maybe just having a place to put money, or maybe dedicated savings accounts or mobile wallets. So people have started talking about using the device as a commitment device of some kind. Or just a way of giving people money through mobile vouchers. And so the project I want to tell you about now is the last one of those, using mobile vouchers. And in particular, in the context of maternal health. So it turns out that having a baby is a pretty dangerous thing to do in the developing world. And it's better to do it with someone who knows about it. So the horizontal axis here is skilled birth attendants, and this is a WDR picture, right? It's a scatter plot of a whole bunch of countries in a whole bunch of time periods in which we've been able to get data on the number of skilled birth attendants per delivery and the maternal mortality rate on the vertical axis. And there's a downward sloping line. Of course, that could be because of anything. I don't know what the correlation is driven by, but it does seem to be a negative relationship. What's happened over the last 20 years? It turns out that there are more deliveries are being attended by skilled healthcare providers. And that is, all of these dots are above the 45-degree line. The horizontal axis is, for each country, is the share of births that were attended before in the 1990s, and the vertical axis is in the 2000s, right? for whatever data we have. And similarly, maternal mortality rates have fallen quite a lot too. On average, they were about half as much as they were 20 years ago across the world. And so this picture has numbers below the 45-degree line. So based on that kind of motivation, it seems like a good idea to improve rates of assisted deliveries in the developing world. So in Western Kenya, we've done a project, which an RCT, not like the first project with Tavneet, in which we've been trying to find ways of getting people, women, to access maternal care more often. What holds them back? Well, it's the usual suspects: cost. You have to pay something when you go to the doctor. Transport. You have to pay something when you get on a bus. Information, knowledge, attention, cultural norms. This is getting a little bit fluffy, but we think there might be something there, right? People do things because their parents did them, or because their mother-in-law did it, or whatever. So there's some kind of transmission of behaviour over time happens. And so if it's about money or it's about information, then maybe the mobile phone could help us help us find a way into that decision-making process and affect it. So I'll tell you about a couple of things we did. We gave people financial incentives to access maternal care. In particular, we gave them money to show up to the doctor or to the clinic. There are hardly any doctors at these clinics, mostly health workers of some kind. We either gave them a full voucher for the full cost of care, or we gave them a voucher, which we call a copay voucher, in which they had to pay about $1 to have a baby. And then there was a control group in which they had to pay the full cost, which is about $10. And they were also, these incentives applied to not just the delivery, but the antenatal care, going before the doctor, before the birth, and postnatal care as well. We also gave them the transport subsidy. And here we had a control group again who didn't get anything, but two groups. One who got what we'll call an unconditional transfer, that is, they got the money whether they went to the doctor or not, and a conditional one for which they got the money if they went to the doctor. So in the theory, in the story, the literature on conditional cash transfers, people make this distinction a lot. Here we just made it because it's really hard to give a woman a voucher before she gets on the bus. And so what we said was, we'll just send you the money. We know when you need to go to the doctor, we'll just send you the money, you can do whatever you want with it. We can't give you a ticket for the bus or the boda or whatever. We'll just give you the money and see if you go. You might think that if these women aren't going to the doctor already, if we just send them the money, they're not going to go to the doctor either. They're just going to take it and spend it on something else. The conditional one, they got the money once they got to the doctor. Okay, so this is our sampling. We got about 1,500 women in there. And also we sent them text messages reminding them to go to their appointments ahead of time. There were two types of messages. One said, remember to go to the doctor. The other one, because we thought we wanted to contextualize this information, we told them about the baby. We told them what a wonderful thing this thing growing inside them was. Not in that many words, it's only 160 characters, right? So you've got to squeeze it down. But we mentioned the baby and the future and how this was great. So, stay tuned. So this is my way of putting up a regression table. I know you all love regression tables. I hate them. So I like pictures instead. So if you go back to this first table up here, we've effectively got 9 cells in there, right? The interactions of the financial incentives. And so this is not talking about the SMSs, just about the financial incentives. The lowest bar there, 29%, that's for all the people who were unlucky enough to be in the controls of both types of financial incentives. They didn't get any money for the bus and they didn't get any money to pay when they got there. So their rate of attendance was about 30%. It turns out if we give these women any kind of subsidy for either the maternal care or the transport or both, that rate shoots up to between 60 and 75%. So global health people are pretty happy when they can increase maternal healthcare utilisation by 10 percentage points. By 10%, I should add, right? Or 15%. We doubled it or increased it by 2.5. In terms of going to the doctor before your kid comes, currently, or the control group for that, the rate at which they went to the WHO recommended number of 4 maternal antenatal care visits was 3%. So 3% of the sample in the control group went the recommended number of times. If we gave them transport and vouchers, that went up to like 20 or 30%. Not a bad return. And in terms of postnatal care, which is when everyone gets immunized, and you check on the health of the mother and the baby, that went from 2% to, again, 30 to 40%. Huge increases. And the really nice thing is that the mobile aspect of this is that we could send them the money when we knew it was time for them to go. Notice there's not much difference between the conditional and unconditional transfers. So we didn't have to make sure they got on the bus. All we had to do was give them the money and they got on the bus, which makes it really easy to effectuate this transfer. Last slide. The informational incentives. Surely all they needed to know was that it was a good thing to go, right? Well, it turns out that most things are zero in here, except this one. And I should have prefaced all this by saying this is preliminary, right? Because it's still back in the oven cooking, but this is what it looks like so far. So it turns out if we tell them a nice, happy story about that baby that's growing in their tummy, they go less. Right? They go, so this is in the control group with no financial incentives. Instead of going 30% of the time, they go 22% of the time. Why? Because we didn't really do that thing called the pre-intervention focus group, where we say, so tell us about having a baby. What's it like to be pregnant? And they say, I'm not pregnant, I've got a stone inside me. That's what they refer to it as. In Western Kenya, they refer to having a stone inside them. Right? Why do they do that? Because the chances are that this is not going to turn out well. It's a good enough chance that it won't turn out well. You don't want to get your hopes up. So there are these Mzungus coming in saying, hey, what a great idea, isn't this going to be good? And they put their head in the ground and they don't go to the doctor. Maybe that's what happened. We don't have great data on that, right? But I think I want to end here by saying, let's take this technology and run with it for all it's got, because it is fantastic. Let's just make sure we be careful on the way. Okay, thanks.
So I can talk about more money, or I can do Swahili translation for Billy, Muzungu, and Boda Boda and stuff like that. But let me continue telling you about this fantastic experiment happening in Africa called mobile money. It's not a random one, but I love it nonetheless. I hope you love it too. So actually, let me get my slides. Alt-Tab, huh? Why is Alt-Tab not?
I think this one's good.
Should be open anyway. Is that going on? Okay, the tab button's clear.
Yeah.
Is that on?
Yeah. So this experiment about mobile money, I look at it as, what if we connect the entire Kenyan population to a real-time payment system? I mean, it's that dramatic. The picture I have there, instead of putting a cute picture, which is the customary thing in presentations like this, I just put a tap. I mean, access to clean water means that. Access to clean water does not mean you can go to a local store, the Duka, and pay an arm and a leg for a 300cc bottle of water. That's not access to clean water. And yet that's the criteria applied for access to finance. Oh, you got a hugely expensive loan from a microfinance institution. Congratulations, you're financially included. For me, inclusion means you're on a network. You have finance on tap. And it's just like water, because water is something that's very useful. You can brush your teeth, you can drink it, you can do whatever you want with it. Finance is the same thing, is the ability to send money for whatever purpose to whomever. So that's the experiment that is happening in Kenya, which is pretty exciting. So let me tell you my subjective assessment of where we are, why is it exciting, all the reasons why it's not going further than it should, and what I think needs to happen in the future. Why it's exciting? It's the value of real time. Information, real time, it's a sexy combination. Information wants to be revealed in real time. That's what this does, which allows me to be able to act on my money the moment I have a need, the moment I hear that my relative has this problem because it's in a drought area. Acting in real time with money is very attractive to people. But the other sense in which real time, and that's of course what mobile brings, is bringing real time everywhere. So it's really not about the mobile phone, it's about bringing real time everywhere. The other attractive thing about real time is that you can escape from direct channels. Banking is about the only sector in the world that insists on direct sales model. You want to do finance? You come to my store, which we call a branch. You come to my ATM. No other sector in the world that I know insists on direct selling model. Everybody else wants to do indirect. Coca-Cola would not be so far if it insisted on Coke stores everywhere. So with real time, we can do that cash in, cash out that Billy was saying in a safe way, because I go to the store, I went to the deposit, here's my cash, you transfer money from your account to my account in real time, done. 2 spot transactions offsetting each other, no financial risk. So what real time allows is to move away from credit, which means now you can sell your service, your accounts anywhere you like. And that's the liberating factor of real time. Third, mobile money represents the power of connecting people. For me, development is less a process of accumulation and more a process of connecting. And I think the research that Tavneet and Billy did shows the power of connecting people. Purely as an insurance mechanism, you could not design a better social insurance mechanism than this real-time experiment happening. And the fourth thing I would like to highlight in terms of what mobile money has shown, certainly in Kenya, is just how inventive people at the base of the pyramid are. This fancy stuff of sending money to a mobile phone, companies still don't know how to use it. It's all individuals at the base of the pyramid who are doing it. Why? Because companies, whose job is it to do a business case for adopting M-Pesa and to doing all the business process re-engineering that needs to happen? Forget that. It's all happening because I'm sick and tired, I'm in the market, I sell tomatoes, everybody down the same row in the market sells exactly the same tomatoes as me. I'm sick of tired of having no differentiation. Now I can buy them further away, I can send the money and the tomatoes appear on the bus. Now I have a better product than everybody else. That is the kind of stuff you're seeing with mobile money. But what are the lows? Well, it turns out that replicating this thing is not as easy as some might have thought. Spectacular success in Kenya, well, it's not really going other places as far as I would have liked. I look at this stuff in many countries. I consider I have the reverse Midas touch because some country mobile money is great until I get to see it, and then it doesn't seem to work. But there's so much hype in this area. It's just not spreading very fast across countries. And it seems like it's a little bit of a tidal wave. Uganda, Tanzania are the second wave, and then Somalia and Zimbabwe and Rwanda. It seems like there is a little bit of a epicenter thing happening. Why is it not replicating? Because it's a brutal economies of scale business. In fact, it's not just economies of scale. It's a brutal network effects business, because if you don't have a lot of people on the network, as Billy said, it's not interesting. But it's not just economies of scale and network effects. It's a huge economies of density challenge, because you need this cash in, cash out points in every village to make it relevant to everyone. So it's just a huge, hungry beast. And other than Safaricom in Kenya and perhaps a couple others, they've not figured out how to break this stuff. Network effects are great when you're big, but they're terrible when you're small. I'm going to be talking more about that. The second challenge or negative that I see is that people who are exposed to mobile money really buy the payments function of it. I can send money home, or I can pay a bill without having to stand in line for half an hour. That's fantastic. But what they're not convinced about at all is the storage of value function. Money has 2 functions: storage of value, means of payment, and if you are not going to store value in there, you're going to have a very weak preference for paying that with that medium. So mobile money remains largely a remote payment mechanism, because for a remote payment, I'll take the trouble of cashing in to send money home. But for day-to-day, why would I pay electronically if what I have is cash? If we don't convince people to hold their money electronically, you will not convince them to want to pay electronically at the corner shop. And hence, you're not bringing mobile money to daily life, and hence, you're only capturing 1 or 2 transactions a month per customer. Goes back to the scale point. It's just not enough transactions there unless you're a really big player. Third problem with mobile money, these players insist on not interoperating with each other. They're mobile operators, but they're using this as an advantage for their core business. They're not interoperating, so it's bad enough having those network effects and scale effects going against you. On top of that, you want to take the challenge on your own. So it's a patchwork of electronic clouds against the legacy cash cloud that includes everyone. And limited integration, meaning that I can download the payments into my corporate IT system. My Excel spreadsheet, they don't offer that, because there's largely driven by telcos, and telcos are not very good about open interfaces. Telcos are control freaks, as we all know. And then operations on a shoestring. You might have a bank or a telco with 1,000 employees, a bank with 1,000 employees serving 5% of the population, but for the rest of the population, here's a team of 40 people, and here's your budget to buy a little mobile money system. So it's just not very scalable. So what I want to just finish off with is 3 journeys that I think we need to go on in order to take this to the right level of scale and the right level of benefit to realize all the opportunities that there are economically and socially. The first is adding more value to individual customers. And I would like to relate it to what are the people's financial needs, but not using the economic jargon that we tend to use, consumption smoothing. I never heard anybody use that word. But what I hear when I talk to poor people pretty much anywhere, it's the same sort of language you keep hearing over and over again. The first one is, my main concern is making liquidity appear when I need it. It's just, well, if I have a need, where can I scratch a little bit of liquidity from? So it's largely a credit story. How do I feed different credit sources so that in a moment that I need, I can scratch that value back? M-Pesa has done that, and that's what's behind the results of Tavneet and Billy, that simply by being able to send and receive money from anyone, all these people now, you're all, my friends and relatives, you're all potentially people who I can scratch liquidity when I need it. And I'll maintain that by giving you sort of that liquidity when you need it. And that's what grows this social insurance network. But people, that's their main concern is, when I need money, where am I going to get it? And people are remarkably resourceful at taking liquidity out of rocks if they need to. The second thing that you hear all the time is it's about income. We tend to think that, well, step 1 is make the money, and step 2 is decide what to do with it. The second one is the finance problem. Well, people just don't think in those terms. Finance is about making more money. And it's not just making more money from a quantity point of view, because what's even more important is the regularity of cash flows. So a common behavior is taking a little bit of daily income, putting it in a Roscoe somewhere so that you can buy a cow so that it produces more daily income. And you figure, and then you go, so how did you gain from sacrificing daily income to produce more daily income? The ROI of a cow is not very high. But it doesn't matter because that's regular income, is the predictability of it. And so finance for them, that's finance, is how do I turn unpredictable daily cash flows into predictable daily cash flows? So if we don't have a story about how M-Pesa is helping them stabilize cash flows, so it's a direct insurance sort of benefit, it's not going to grow that much faster. The third issue that people have, and I'm putting this in what I think subjectively is the order of how frequently I hear these things, is avoiding leakage of liquidity. Because today I had a good day, I have to take it out of my pocket because cash burns a hole out of my pocket. So finding legitimate uses for available money when there is available money, just discipline. And by far the least common thing that you hear is large expenditures and meeting goals and all that kind of stuff, which is what we tend to emphasize on. So 3 and 4 are the saving, go to the core of the savings function that I was talking about earlier. People are not finding M-Pesa a good way to manage available liquidity or to build up for cash flows for big lump sums that they need to buy for the future. And the question is, why is that the case? And to me, it's fairly obvious. I mean, the first thing you want to do when you take that cash out of your pocket, because otherwise it'll burn a hole in it, is you start allocating, you start acting out a little scenario in your mind, because this money is for education, and it goes in this jar, and this money is for this, and this money is for that. Now, don't make the mistake of taking that too literally. Just they want associated mental images to their money, so that's a little bit of a deterrent from misspending it. So, what is the competition of M-Pesa from a savings point of view? Well, it's these kind of places to store value. You might think that this is very archaic, but for people this is highly intuitive. When you put money under the mattress and when you put it in that jar, these are not substitutes. These are very specific meanings in their own lives, and it's very intuitive. There's no user manual there. Or these boxes: when do you want to lock? When do you not want to lock? When do you want to keep the lock, the key yourself? When do you give the key to someone else? All this is charged with meaning. And we pretend that, okay, forget about all that, and here's a digital account a single digital account starts saving money there. I mean, we're just not going to go anywhere. You're going to have the jars that you actually have to break to get into them, the mud banks. not to mention the animals, hugely sophisticated savings products that include all the discipline devices you can imagine. It's indivisible. There's a waiting period. It has social meaning. There's peer pressure because everybody will get to know that you just saved. But no, here's saved in this little electronic jar, and of course all this peer pressure stuff. So how are we going to be emulating these informal practices in a digital world? I have some ideas on that, but I just want to pose a challenge for all of you. The second journey. The first one was for individuals to find more value storing, because if I store value there, then they want to pay more electronically. The second one is the enterprise. Why are enterprises completely outside of the M-Pesa system, by and large, is because they have all sorts of barriers, trust. In a personal setting, it's quite interesting. I thought M-Pesa had broken the trust barrier, because I don't hear about trust issues, but in a business setting, it has not, because someone walked into my store, they pay me electronically, I give them the goods, they walk out, they call the call center and say, oh, I made a mistake, transaction was made in error, please reverse it to the call center. You would not do that to your mother when you're sending money home. You would to a business. So just the nature of trust just breaks, completely changes. There is no process with M-Pesa to manage authorizations and reconciliations because, I want to send money to someone, but Billy is the CFO. He needs to authorize. M-Pesa, well, just doesn't have that. Or an even bigger problem, we got paid through M-Pesa. Someone sent us money. Who the hell is this person? Well, why did they send us money? And if I know who the person is, for which of the invoices is it? That has none of that manageability. So we need to go from a system where you make payments to one where you manage payments for it to be useful for business. And the third one I would like to mention is the regulatory journey, which I think is a big deal. This is the original view of banking, perhaps being a bit harsh. By black box, what I mean is monolithic. So only through direct channels, and I'm going to regulate what a branch actually looks like. It has to have a kitchen even for staff. So it has to be direct channels, and one size fits all banking. You need to be a license, and know your customer for account. You just have to face. So hugely expensive stuff doesn't work for 90% of the population. Where we've gone is, by and large, is to an enablement of new business models. Where the central bank has said, okay, fine, I relent. This cash in, cash out stuff at stores makes sense, but you need to sign a contract with those stores because they're an agent of you. So that's made it possible. Or, banks are a bit monolithic. How about a payment system provider license that allows you to do some of this M-Pesa stuff? Oh, but no savings because this is just a payments company. Or reduce KYC, photocopies are not necessary, just that kind of stuff. But where we need to go is where the regulation not only enables, but brings down barriers to entry. Because in my view, there's no reason why the cash in, cash out points need to be contractually bound to the bank. This is just a real-time exchange of goods. Like when I go to the store to buy rice, that store is not an agent of the rice company. That store is just selling rice that happens to own. It's the same thing with cash in, cash out. And of course, what would happen then is if I become a cash in, cash out point independently of the banks, I can do cash in, cash out for any bank that I want or any mobile money system simply by having my own account in those institutions. I can exchange my liquidity in the bank with my liquidity in the till. And that would then break down the barriers to entry because there would be spontaneous emergence of cash in, cash out networks independently of those people who want to provide mobile money services. Second is the idea of narrow banks. I think I cannot understand this one, but it's a misunderstood thing that this degraded banking license is about limiting what you can do on the liability side. Oh, don't issue deposit, it's not a deposit, it's not. Whereas the real issue is limiting them on the asset side. You're not a licensed bank, you're not a prudentially regulated bank, so just don't do anything other than deposit the money in a bank. And the third one is there should be an entry level into more money into banking where there's no KYC required at all. That should kick in later on once you meet certain transactional thresholds. And so you move from a regulation that enables to one that really makes it easy for entry and competition to take place. Thank you.
Where's tab on this system?
Oh, technology. It's not working.
Oh, okay.
So which one?
Set a trend.
Oh, yeah. And that should work.
All right. So the technology panel completely failed at switching slides, so I was... Anyway, so thank you so much for inviting me. It's really great to be here. So I had the kind of the challenge of trying to anticipate what Billy and Ignacio would say, so I think I did a pretty good job, but I may have missed some things. So, I mean, this shouldn't really be sort of news to anyone in this room, but I think what we've seen over the last 10, 15 years is really a growth in the sort of access of mobile phones in the network. And so you can see just how rapidly it's grown. I mean, this is a little bit old, but you can see how it's really grown relative to other infrastructure. And it's been really grown dramatically. So for example, in 2000, you got about 15 million. It went from 50 million people, with mobile phones to 650 million in 2012. So really, really large growth rates in mobile phone adoption. 80% of adults in Kenya, Ghana, Nigeria, Egypt, Senegal, and other countries have mobile phones now. So, and one thing we should just, again, shouldn't be surprising is, we're talking about the old, dumb Nokia phones that, that's what most people are using, not our smartphones that we're all addicted to. And so that's something to keep in mind as well. So there's a growing evidence on sort of the economic impacts of mobile phones. So Billy and Ignacio sort of went over some of the things that they've looked at. So, M-Pesa and risk sharing and sort of the potential for mobile money to promote inclusions. I'm just going to try and sort of, I think, highlight a few things that I anticipated they may not discuss. So just looking a little bit at agricultural markets and just also a little bit on governance, and then I'll go back to M-Pesa and if you want to sort of look at other review papers, you can sort of refer to Mbiti 2010 and Blumenstock. So this is a famous paper by, let me just point to the Jensen paper on price dispersion. So here, and again, there's also similar results in Niger, but basically what they find in this paper is, you have this mobile phone rollout that sort of comes into place in southern India, and they basically exploit sort of the rollout to look at price differences. And basically what he can show is that as a result of the network coming in, you sort of have sort of much lower price dispersion over time. Okay, that's sort of a nice fundamental result. But what we've seen recently is some conflicting evidence. So there's two RCTs, one in India, one in Colombia, where they actually provide farmers with phones and prices. And what they find is basically there was no impact on prices, at least the prices that farmers received. And the big takeaway from this is that market structure matters. So often in many agricultural markets, there is a monopolist trader, or trader markets are monopolistic. And if you have such a market, basically information is not going to be sufficient to really improve the prices that farmers receive. And so the big takeaway is that, yeah, mobile phones are great, but they can only do so much. And the market matters that we're dealing with. Similarly, if we're thinking about sort of governance, so there's a lot of sort of, I think hype and excitement about sort of the potential for mobile phones to improve governance. So I think we've seen some evidence of mobile phones being used to sort of reduce voter irregularities, increase voter participation. Now there's all this hype about accountability through crowdsourcing for public service delivery. So I think in the UK you have this fix my street thing. There's I paid a bribe. There's all these things that sort of rely on sort of customers and users sort of sending text messages and sort of complaints, and those sort of going up the sort of reporting ladder. Well, there's some evidence. So there's, in Punjab, the government sort of was very proactive about this, and now whenever you use a service, they sort of send you out an SMS and a robocall saying, report any problems you have. About 2 million people have received these calls, and 300,000 have actually replied and sort of given their feedback, and there's been about 8,000 reports of corruption of some kind. And, so it seems to be, at least in terms of people reporting, it seems to be pretty good. And there's ongoing work that's being done now to sort of tease out the impact evaluation of that. They have another one, they've been trying all sorts of things in Punjab. One on looking at the healthcare accountability, so they're looking at using smartphones to actually monitor the monitors in this dengue reduction system. The evidence there was actually, well, it works, but only when this sort of incentives and things matter, in the sense that only when you were looking at electorally competitive constituencies where, votes matter and people actually have to respond to voters and their concerns, that's actually when this stuff was able to work. So again, it sort of illustrates the idea that, we really have to think, not just get the technology right, but we also have to sort of think about the markets and the context in which the technology is operating. And, in contrast, so this is something I sort of looked at for a little bit, but it didn't go anywhere. But there was a system in Kenya called Huduma, which was a NGO-led accountability system, and it basically has failed to take off. And the idea again was, very nice and sort of sounded great on paper. Citizens could go to be able to report any problems. These would be sort of put up on a public display on a website, sent to the ministry of whatever the relevant ministry. And the idea was that this would sort of pressure the ministry to act and sort of fix these problems. But again, there was no real link to government, right? So, the government gets them and just basically throws them away. So there was no real action as a response to any of these reports. And so, there was no real incentive for a provider to change their behavior, and there was no incentive for citizens to report. So if you go on the website now, you'll see maybe like 100 reports. It's been up for about a year, or almost 2 years now, okay? And then I think just a general question that I think a lot of these systems have to sort of think about is, can sort of retribution by providers actually discourage the success of these things? So if you sort of go out and whistleblow, can the provider actually punish you? And now, so that we have some evidence that this doesn't really matter, at least in a lab setting, but, I think that's something to keep in mind as we sort of scale these things up. So back to mobile money. I'm sort of jumping in different literatures, but I hope you'll keep up. This thing has been just dramatically, I think, revolutionized a lot of things. I think one of the things that Ignacio had pointed out, which is, I think, very interesting, and I think is, it's really an East African thing. So East Africa, 34% of all mobile money accounts globally are in East Africa. Okay, so it's really, really successful in East Africa, less successful everywhere else. And you can sort of see this here, where you can see, Kenya's, by far way ahead of everyone else. 68% of adults who use, mobile phone owners actually use M-Pesa or some sort of mobile money system, whereas in Ghana it's only 11%. Okay, and so there's questions, why is it working in Kenya versus Ghana? I think Ignacio sort of did a good job talking about that. Again, this is sort of just a little bit more data, just comparing banks and mobile money usage. This is from the FinAccess survey of 2013 in Kenya. And, essentially this is broken up by education level. And what you can see pretty clearly is that for people with low education, they're much more likely to use mobile money accounts, right? So, one might argue perhaps potentially there is some sort of substitutability there. Whereas if you look at people in highly educated people, they're using both of these, mobile money and bank accounts. So maybe these are more complementary for them. But let me just skip this. Couple of things. So I'm going to just go through a bunch of sort of random results in some sense. So one of the things we did a while back was to sort of think about how the introduction of M-Pesa actually affects the market for remittances. So prior to M-Pesa coming in, you could sort of send money by your friends, you could send it by the post office, by banks. You could also use actually the formal Western Union and MoneyGram. Okay? So what we did was we sort of took all the MoneyGram fees from over the period. So we looked before and after, and what we can actually tease out, sort of exploiting sort of the cap on M-Pesa actually, is basically what you see is a 50% reduction in prices after the introduction of M-Pesa, of Western Union and MoneyGram prices after the introduction of M-Pesa. And what we can show, basically, is that 60% of that drop, almost 2/3 of it, is actually due to competitive pressures from M-Pesa. Of course, those price cuts didn't really help, because basically M-Pesa wiped out the market, right? So M-Pesa comes in, basically, the post office, bus, Western Union, they're basically driven out of the market, and M-Pesa is now the dominant method of transferring remittances. And if you look even to 2013 data, you'll see basically the same picture. So what are the other implications of mobile money? So let me preface this by saying I am not a macroeconomist, but I had to sort of learn a few things about macro. So what we try and do in this couple papers with David Weil and also with Francis Wega is we just try and understand sort of some of the implications of monetary implications of M-Pesa. And one of the things that we try and do actually is just think about how mobile money fits into the broader monetary framework. And we do this by developing what we call the velocity of M-Pesa. Okay? So just so that if you will, I'm going to assume everyone's like me and has forgotten everything about macroeconomics. There's two definitions of velocity that are used in monetary economics. So the first one is income velocity, which is sort of the usual definition that we use and thing we usually work with. And that's usually defined as nominal GDP divided by the relevant money stock. And then we also have transactions velocity, which is the frequency with which an average unit of money is used in transactions. And arguably transactions velocity is actually the more relevant and fundamental measure, but it's actually really, really hard to actually get a hold of because you have to actually observe transactions. Okay. Fortunately, in the M-Pesa case, we actually can observe transactions if we sort of view them as sort of sending money from one person to another. And so what we do is we define sort of M-Pesa velocity as person-to-person transfers divided by the stock of outstanding e-money in a particular month. We have to make some adjustments for the transactions and values held by agents, but that's, we can do that. And just sort of so that you understand what this means, if you find a velocity of 5, that would basically say that a unit of M-Pesa is going to be created at the beginning of the month, and then it's going to change hands 5 times, and then it's going to be extinguished at the end of the month. Extinguished as in it goes back to its home in Safaricom and rests in peace. And so we can sort of take all this data and calculate sort of what the transaction velocity looks like, since the beginning of M-Pesa to mid-2010, which is when we had the data. And one you can see basically is that it's rising over time. Okay. So right now, well, at least as of a few years ago, we were looking at about 4 to 5 transactions per month for a unit of M-Pesa. Okay. So what does that mean? Basically, a unit of M-Pesa is transferred every week on average. Presumably, given what we know, you're talking about a mix of units that sort of basically exist for less than 1 day. Basically, they just sent, I create it, I send it out, and it's basically returns back to M-Pesa and rests in peace. And a few others that are basically sent stay on people's phones for a really, really long time. So you have this mixture of people who are basically just cashing their M-Pesa out, sending it out, right? So basically I send money to Billy, he cashes out immediately. There's a lot of people doing that. There's also a lot of times where, I'll send money to Ignacio, he keeps it for a while. Okay, so it's a mixture of those two things. If you had a velocity of something like 30, that would sort of be basically people sending back and forth all the time, right? So higher velocities are going to basically indicate or suggest that you're basically using this primarily for transfers. Okay? So we're somewhere in between, so it's sort of a mixture of transfers, but we think it's mainly transfers. Okay? So why should they care? Why should central banks care about this? Well, if you go back to sort of the quantity of money and what you really want, if you sort of think of mobile or e-money as sort of a separate class, is you sort of want to, you want to think of the quantity of money as some velocity-weighted aggregate of all these different, currencies. So you want to think about, M1, M2, and M-Pesa. But right now, does it really matter? Not really. Okay, so relative to the other sort of M1, M0, basically, it's tiny. Okay, so it's not really we're not really at the stage where it's really going to have a big monetary impact. but it could. And I think that's something that we need to keep an eye on. A couple other things we can do. We can actually look at transaction data to infer discount rates and of customers. And again, this sort of tells us a little bit more about how people are using it. What's interesting is that if you look at the M-Pesa price schedule, there's a lot of these notches, okay? Now, okay, M-Pesa doesn't pay balance, you don't get earn interest on your balances, but what you could do is actually save money on transactions by sort of withdrawing larger amounts, okay? So if I withdraw 1,000 shillings each month, for example, I'm going to pay a pretty substantial withdrawal fee. But if I sort of save it up, withdraw 5,000 in 5 months or something, I'm going to actually save quite a bit on my withdrawal fees. Okay, so we have sort of some data from some various sites, and one thing you can see, which is that there's a lot of small withdrawals that are occurring. Okay, so people are actually withdrawing less than 1,000 shillings often, and that's quite expensive. Okay, so you can see basically, well, you can't really see it very well. If you look at, these are sort of different agents. There are a bunch of people withdrawing less than 1,000 shillings. There are also a bunch of people who are basically withdrawing round numbers. So they're withdrawing 1,000, 2,000. But we don't see any sort of bunching at price notches, which is what we would have expected if people were actually trying to sort of take advantage of the price schedule, right? So you can see here, for example, that if I withdraw 2,000 shillings, I'm going to pay quite a bit. But if I was to, so you can basically game the system and sort of, withdraw a larger amount, and actually, so you would, you could say, you'll see people, for example, withdrawing, 2,500, and also people withdrawing 2,600, right? Which means that, that extra $100 they're spending, and, they're being charged an extra 20 shillings to withdraw that extra 100 shillings, right? So, and you see that quite a bit. So people aren't really responsive to these notches as we would have thought they would be. So that sort of implies that, they actually have kind of high discount rates, okay? So what we can do, just sort of back of the envelope, is just sort of looking at sort of what, how they're withdrawing things and sort of what they're doing relative to the price notches. We can actually show that on average, the implied discount rate for an average customer is about 36% per annum, which is pretty high. Okay? And so there's a question, why is that? And I think that's something we don't really know too much about yet, but we're working on. So what's the future? There's a couple things that are interesting that are going on in this landscape. I think Ignacio sort of pointed to some of these. One is sort of a greater linkage between M-Pesa and banks. So M-Shwari is a new product that is launched in Kenya. It's a partnership between Safaricom and a local bank in Kenya. They're actually offering interest-earning savings accounts and small loans. There was about 22 million deposited as of late 2000, and 10 million in loans were dispersed, with about 3.8% bad loans. So this is all mobile banking, right? This is mobile banking, sort of the future. Another thing that's actually kind of understudied is these value-added services, especially Airtime Credit services. So again, I'm going to use Safaricom as an example. So they have this thing which is called Okoa Jahazi, which you could think of that as save my boat, roughly speaking. Basically, this allows you to, if you run out of phone credit, and you need to call someone, you can borrow from the cell phone company. So what they'll do is they say, okay, if I can borrow 45 shillings, for example, which is like 50 cents roughly, for a fee of 5 shillings. Okay? And then when I top up my phone credit the next time, they basically take that away straight away, and then whatever is, let's say if I topped up for 250, they would take the 50 shillings right away, and then I would have only 200 shillings worth of talk time left. So that in that way you repay the loan. You have about 4 days to repay the loan, or else you're banned from using the service for a week after you repay. And you obviously can't use it while you're still in debt. And you can actually borrow up to 900 shillings. So you can borrow basically quite a bit, 400 shilling fee. So what's going on with these services? So, I sort of asked a few sort of telecoms to provide me some data. So so there's one telecom, for example, that has about 1 million customers, and they sort of report that about 13 to 15% of eligible customers are actually using this daily, okay? On average, each active customer conducts 6.2 transactions per month. You see similar numbers in a different market, well, slightly lower. So here they only have 3 to 5% of eligible customers using the service daily, and they're making about 4 transactions a month. Bad debt is about 2 to 4%, and that's actually declining, is what they're telling me. Again, mainly due to SIM registrations in many countries. So, the first thing that this popped in my mind is this really looks like a payday loan, kind of, because people seem to keep coming back to this and coming back and sort of using this a lot. So it really reminded me of payday loans in some sense. The other thing that's going on is it's actually giving phone companies a lot of data about how people use things, how trustworthy people are, especially now as people are forced to register their phones to their national ID cards. And so what's happening now is that I think a lot of phone companies are actually starting to look at this data more carefully and try and actually use them to do credit scoring. And if they can actually do this properly, this could have actually big implications for the efficiency of credit markets and the development of the financial sector. So this is actually an interesting area that's, I think, opening up and will be changing rapidly in the next few years. So I'll stop there. But thank you very much. And,
Right, well thank you very much to the three presenters for some very interesting ideas. Let's take some questions. We'll try to take them if we can in blocks of 3. And I think we've got Michael and Lily who are running microphones for us. I think that's fine. Let me, yes, okay, so we've got Derek over here, if that's right, Lily. Yep. Yep.
Thanks. So a question, sorry, I'm Derek with IFPRI. A question for Billy, but also the other speakers, I guess. Billy made a kind of throwaway remark about the growth impacts of these programs. I can see that as long as you have a plausible identification strategy that these might be quite effective safety nets, but the question a lot of people ask of safety nets and weather insurance and I guess these schemes, is there any productive impact? You alluded to kind of Stefan's work on this. Is there any evidence that people are migrating more, making productive investments and so on? Thank you.
Thanks. So let's take 3 before we get an answer. Yep.
Yeah, hi, Brian from the University of Washington. Just a quick follow-up about the savings account that Ignacio mentioned and then Isaac gave a little more details on. I'm just curious if there's any evidence yet on whether or not these Mshwari savings accounts are being used as essentially alternatives to existing savings groups, or whether or not you see reallocation from an M-Pesa account into the savings account, and whether or not the interest rates are competitive. Just any more information on that would be great. Thanks.
And Marcel.
Yes, this is a question for Ignacio. I was just wondering, in your experience with the fact that M-Pesa has not taken off in other countries like it has in Kenya, is due to the fact that the existing operators in the other countries have wised up to this possibility and have taken either preemptive strikes in terms of lobbying the government for regulation that prevents entry or makes it much less profitable, or have acted on the market itself in competitive ways that prevent entry and make entry more difficult.
Great. Okay, let's take those in turn if we can. I think the first one was to you, Billy.
How are we going now? Derek, thanks. So first of all, I direct you to Lorenzo, where's Lorenzo? He just gave a paper in the last session about the output effects of mobile, of ICTs. I think it's fair to say that the impacts on the level of income will be longer term than on the impacts on the distribution of risk. We're actually planning a follow-up survey soon, we're planning it now, to try and find these households 4 years later. I'm always reminded of Robert Soller's comment, in the 90s. He said, you can see computers everywhere except in the data. And I feel that we're kind of at that position now with mobile technology. You can see it everywhere. And I want to know if it'll make people richer. I'm not sure. So I think there are plenty of mechanisms, right? Trade is what makes us rich. And so this, as Ignacio was saying, if this facilitates trade of the tomato sellers, etc. But I think we need to see that, yeah.
So on Mchari, I have disappointing news, I'm afraid. If people don't find one simple electronic account useful, then putting another one is not going to transform the problem. The problem is always that banks and telcos love reporting average balances, but those are useless because they're driven by the top 10%. They all look like this, the distribution. So never look at average balances. You have to look at the distribution, and there's very little money there, just like a M-Pesa. And by the way, just like banks, this is not because it's a mobile. Look at the banks in the country, Equity Bank and KCB, at the base of the pyramid, they're all empty just the same. So there's something about digital. Just to give you a little peek preview how I would propose to handle this is to have much more flexible jam jarring of money, which is, for example, I can send money to myself. Today I got some digital money because I got paid. I send it to March 28 because that's when the school fees are due. I send the money to myself to March 28. It's my March 28 money. Or I send it to Fridays because the Friday, put some money aside for Fridays because Fridays is my drinking money when I go with my friends. Or stuff like that. Or I can send it to Yellow because it's my Yellow project. We can send money to any notion. It doesn't have to be just a mobile phone number. So that's the kind of things that I'm working on. And Marcel, what was the question?
Question about preventing entry.
Oh, other countries. Yeah, that's right. Sorry. I mean, there's no question that Safaricom had a huge advantage because it's a quasi-monopoly in the land. And that hugely significant because not only has a lot of potential customers to cross-sell the service, but every retailer in the country is eating off of its hand because every retailer in the country is selling airtime. So it's a huge amount of customer base on both sides of the market that is very attractive. You go to Tanzania, the mobile operator with the biggest market share has 42% market share. And they go, why I don't have 85%? Crybaby. Now, the thing with 42% is that, of course, you have 42% market share in a market that 50% of the people have a mobile phone. And assuming you're very successful, 50% of your customers take up a mobile phone, congratulations, you have a payment system over 10% of the country. It just doesn't work. But my solution to that one is easy. It's like, okay, you're talking to the phone mobile operators all complaining about how Safaricom has more market share. And I go, well, the four of you together have 100% market share. So what's the problem? Interoperate. But the reality is mobile operators are doing this to punch in the eye of their competitors on the voice market rather than because they're trying to create a new market. That's really what it comes down to, which is why they don't want to interconnect, because they're trying to drive advantage from a branding point of view. Sadly.
Right. Thank you. Right, 3 more questions. We got one over this side to start. So we got one down here, Louis. Let's start with Bola.
Yeah, I'm Bola Utste from University of Ibadan. My question is on the proportion of adults in some selected household in countries that uses mobile phone. I just wanted to clarify that. I was wondering how was this calculated? Because if you are looking at the number of phones being bought, then you might have an erroneous number. Because in my own country, Nigeria, you could have someone that has about 4 mobile phones for each network to be on the safe side. So that could actually raise the teledensity and might not really infer that people are really adopting mobile phone. And my second question is on the issue of mobile money. I was just wondering, for instance, if I send money or I bought a recharge card and I sent to my mother in the village, and she has 2 options, either to use it as airtime to call or resell to someone. Could that also be clarified as mobile phone, mobile money? Thank you.
Thanks very much, Bola. One of the JAE fellows here at CSE for this past term. There was a question down here somewhere. Michael, can you go that one?
My name is Jean-Philippe. I'm from Örebro University. My question is to Ignacio. I was wondering, related to what Marcel rose earlier, one of the reasons why there's not much more expansion to other countries would be perhaps that no one expected M-Pesa to grow this big, so the oversight from the government when it comes to VAT collection, for instance, it was never put in place, and now it's kind of too late to really fix it. Seeing the potential it has to collect VAT would make a huge revolution, because VAT collection rates are terrible in Kenya, and I was wondering whether this plays in the equation. Thank you.
Thanks very much. And let's, right here, yep.
Thank you very much for the presentations. My question relates to global integration, that is globalization. To what extent can we use the mobile technology as an index of social globalization between countries? Right? Because we could see that mobile technologies are widely used in countries, and in the literature, there are many people who use this as part of the things employed for the computation of globalization index. So, do you think this approach is all right, or are there other forms of technologies that should be incorporated into the globalization index?
The list of the first two cohorts of students from the 4 schools that were selected. And we use archives from the school, colonial archives as well, to determine who were the first 2 kids ever to have been selected. And we know that those kids went to school without clear knowledge of how good school could be for their individual or collective well-being. We also use informants in the village, especially elders, to verify the information that we get from the archives. Now, it's trickier to actually to document those who did not go to school because there was no census at that time. You can have the list of those who've been to school, but those who were not, the general population, we have no idea who they were. So what we did then is do what we call backward sampling. So we went to a village, randomly select a number of people, and then ask them who their grandfathers are or were. So if the age of the grandfather is similar to the age of the people who went to school, then he qualifies to be in the control group. If not, he doesn't. So we sample the living as a way to sample the dead from 150 or 75 years ago. Now, in the paper, we explain in details how this was done and how this is a credible way to sample the population at that time. So, and then we went on to sort of use a social demographic survey to find out about education, income, and also the family characteristics of those individuals. Now, here is, for instance, a sample of archives that we are able to locate from the school. Here is the first cohort, the very first cohort of the school from Zangirado. So actually, the people that we checked, that we documented, were exactly in that picture. And so here's a picture of them being at school with the priest. And then, as I mentioned to you, we use colonial archives. Here for an ID card of one of the kids that you saw. You didn't see him. One of the kids from the previous picture who grew up in 1956 was a businessman. And that's his picture. So we use that information to double check. So the data that we got from the informants. So this guy is the only living member of the cohort from one of the locations. The location is in northern Benin. The school was created in 1923. So He was part of the first two cohort. We were able to interview him in details. So not only we have an archive, but we have one of the leading members of the cohorts who gave us all the details about his classmates and so on. Unfortunately, he died about a couple of months after, so there's no correlation between the interview and the fact that he died. So have nothing to do with what happened. So, and then I was very much part of the interview process. So you can see me there interviewing one of the informants who used to be the administrator during colonial times in Benin. And so it was a very detailed, long, painful process. So that led to the data. So now, so we wanted to see how education spread spatially. So we need to document not only people who've been to school, their family members, but also their neighbors. So that spatial spillover of human capital. Now, what about intertemporal? What about how the value of education, the benefit of education spread over time? So for that, we need to have a sample of descendants, people who, basically the children, the nephew and nieces of those who've been to school, and also the children, nephew and nieces of those who have not been to school, living near a school or not near a school. So having the descendant of the three groups that we are considering. So basically what we did, we had the enumerator listing all the children of the subject from treatment 1, treatment 2, and control, list all the siblings of treatment 1, treatment 2, and control, and then sample the children for each subject, if the number of children is less than 10, and then sample the sibling as well. And then when we have the sample of sibling, now we also go to list the children of those siblings and then sample the children of the sibling to get the nephew and the nieces. And then based on that, we also try, we did a social demographic survey. So you can see there were about 80 people involved in this work, and we started in 2009, and it's still going on. So it's I think an extremely important project for a wide number of reasons, and that's why. Okay, now, first, there is a sense using the pre-treatment variables to see that the treatment and control villages that we selected were similar, similar geographic, political, economic characteristics. And the individual that we have treatment and control villages were also similar as well. Now let's talk about the results. First results, effect on income. So only 14% of those been to school were farmers, while those who have not been to school, 84% of them were farmers. And you can see in terms of water, access to water, to electricity, the outcome is better. Importantly, they are more likely to be politically active, and also, they are more likely to have white friends, which at that time is it's a pathway to success. So now again, individual treatment strongly increased measure of living standard and wealth. So as you know, one picture is worth 1,000 words. That's a treated guy, So it's an actual family in our sample, and that's an untreated family, So the main difference, as you can see from the two pictures, is that there is one guy here who is wearing shoes, and no one was wearing shoes here. So I think the living standard of a treated from that picture alone tells the story. Now, in terms of housing, here is, it's not a typical housing, but it's a house of an individual from treatment 1, and here is the house of an individual from treatment 2, like someone living in a village with school, who have not been to school. So when you live near this house, you might as well get this one, So now, when you don't have this house around you, all right, you are stuck with this one, So as a result, you can see from housing quality how the presence of the educated affect the neighbor and affect the choices that they make. Now, the treated subjects have higher social status and wider social networks. They are more politically active. So for instance, here is the data that you can use to, for instance, look at the causal effect of education on political participation, because those who were selected to go to school were to some degree selected randomly, and you can, if the effect here on political participation can be seen as causal. Now, let's look at the effect on, and this is really the punchline of the whole paper. So, you can see the gap between the children of the educated and the children of the uneducated had drastically shrunk. It was 90% in the first generation and 20% second generation. So people living near uneducated became crazy about education. And as a result, the story that I told you earlier led to this kind of outcome. And in terms of university education, for instance, there is no much difference between the children of the educated and the children of the uneducated. So, and doing the work more rigorously, you can see that being in a village with school gives you, much higher probability of being educated than being in a village without school. And the additional effect of coming from someone who is educated is sizable, but it's not that huge. And the gap decreases when the level when you move from primary to secondary education and to university. Now, same thing. The kids have more wealth, and there are strong village externality from school, and this as I'll tell you later, this could be due not only to being close to someone and aspire to be up to someone who have been educated and aspire to be like him or her, and also maybe development outcome that comes with the school. The fact that because there is a school, then there are like the markets, the shops, and all these come, and as a result, everybody in the area, whether they have been to school or not, is better off. Now, so here is a picture of someone from the second generation. Now social ties, same thing. Now family externality is also one of the punchline of the result of the paper. So listen to me. So children and nieces of the treated parents are significantly more educated than descendants of people with no education and people from control, but the children are by and large not more educated than nieces and nephews. So African families were a powerful instrument in spreading education. So when you have an educated member, an educated person in one family, the effects on nephew and nieces are extremely strong. So in a time where we talk about family tax and we talk about how backward African families can be, we need to really also think about the fact that they were powerful instrument for the spread of education in Africa. So, and what are the mechanisms? The mechanism we can think of are several. So we in this paper we talk about aspirations, given the fact that those who live near someone educated try to emulate him, but also there are additional effects of the entrepreneurs who are educated. I'm going to talk about that in a second. So first of all, aspirations. So, and the way we capture aspiration is distance from the school, because distance from the school put you in touch, put you in contact with the educated, whether you are uneducated, even if you are uneducated. And then another crucial result is that we find a sibling of the educated, of uneducated who own a shop are 20% less likely to be farmers, and their descendants tend to be more educated. And 40% of descendants of educated shop owners have secondary school education, compared to 20% for those without shops. So the power, the strength of externality is stronger when you actually use your salary, for instance, as collateral or whatever to open a business. You know, and I think this is an important point to raise. It might be a way to show that, for instance, the redistributive feature of African families can be mitigated, for instance, if the educated is encouraged, for instance, to open a small business, to open a family business as well. You know, it's a way of replacing workfare with welfare in the family. And it has a direct effect on how influential, how powerful education can be on the neighbors and children. So, as I mentioned earlier, so, you know, typically things happen around school, you know, like market, shops, colonial administration, road networks, health clinics, you know, and that's local development. You have hubs of cluster, I should say, cluster of academic excellence. Sometimes goes with clusters of development as well. So this was true then, it should be true now. So how do you turn this into policy? So there are several ideas that come from the qualitative evidence and also from the quantitative evidence that we have collected. One is investment in institutional capacity. You know, I mean, schools then were basically like semi-military style institutions. You know, I mean, if you are 2 minutes late going to school, I mean, you sweat, you know, because you know the teacher is already there. You cannot come to the class after the teacher. That's it for you, you know. So if now, as we know, we see earlier, the teacher is late half an hour or an hour, then nothing left, you know. We also need to raise standards and accountability. Those days, from the qualitative data that we have, inspectors were crucial for quality control and